If you look at the 930 high, okay, so all I'm going to be doing is pointing out things that are noteworthy for you to have in your journal and showing the points of reference that I'm referring to here, and that way you can study it after the day closes. But this wick here, see that? It went up into that fair value gap, cleared the buy side. Once it did that, watch what this is doing here. Where is it returning up into? Yes, it touches the bottom of the 60-minute fair value gap. Yes, that's permissible. But where are the bodies? Where are the bodies at in these two candles? In deference to this wick. Look at that beautiful return to another week opening gap. So the next one of interest to me, and I'm sure you probably saw it when I was flashing my screen, which is on the daily chart. Way down here. Okay, so we have to use other tools in our repertoire. Not to say that it can't crash down here. I mean, anything can happen. I'm not saying that's happening today, but that's the next new week opening gap that I have on mine. So if we have the focus on that wick right here, and draw a fit on it so you can see. But ICT, I could have shorted there. Yeah, I could have. We could have ran up higher into that 60-minute fair value gap too. You have no idea. I don't have any idea what the Fed chair day testimonies is going to present in terms of volatility. But look how beautiful that retracement is off that 39.7450 level. So this price level here is, oh, I can't make that out. 39.92.75. The closing price here comes in at 39.93.75. So the close, yeah, 3993.75. So the close comes in exactly at that price. I'm going to sit right up here. See that? That's probably random. To most viewers that are casually just watching, that's just randomness. But that's not randomness. That's algorithmic. It goes right to that. Now, the Wicks can do the damage. It goes just outside the lines. And this is how the algorithm hides in plain view. In plain view, everybody that's watching price, and there's strong deniers still out there saying that there is no algorithm controlling price, when there's absolutely so much evidence to argue the point that there is. And why all of you would even wrestle that idea is beyond me. I'm sure it's unsettling. It relieved me because it made much more sense why the market does what it does repeatedly, over and over and over again. So prior to this drop off here, that candle right there is 9:55, and we started another candle at 10 o'clock. Powell didn't even get a chance to say anything. And right off of consequent encroachment, after tapping the 60-minute fair value gap that I mentioned, ran all the way down to what? New week opening gap here. Look at the beautiful delivery off of that, back up into another new week opening gap. Now, take Powell out of the conversation. Say that wasn't a factor this morning. This run up to that 60-minute fair value gap would have been a short for me. I would have smacked that. As soon as it went up there and hit it, I would have done that. Why? Why would I have done that? And I can say this because you've watched me call these things live now. But I would have absolutely smacked that as a short entry had Powell not been a factor this morning. The reason why I would trust that is because we've already done the buy side here, and it also went up into the next premium range, which is that fair value gap there. So I would feel comfortable getting short there with a stop above the fair value gap once it hit that. At one time when it was bold-faced green, all body, no wick at all, when it was touching that, that would be terrifying to the average trader. It doesn't make any sense to sell short into something like that. Rate of consequent encroachment of that wick here, after hitting the 60-minute fair value gap low, expansion occurs all the way down to some random 39.7450 level. This entire run back down into that there, it only went 1/4 point lower than the 39.74.5 level. And that's a gap that's already been traded to. And as a reminder, as I mentioned yesterday, there's folks out there that just absolutely tore up that I'm teaching you something that nobody's ever touched on before. Gaps exist everywhere. But how I use those gaps and how I frame a narrative. You never hear anybody teach about how old gap from a week, months ago, weeks ago is useful right now. You don't hear it. It's not taught. But there's logic behind it. There's logic behind weaving together a narrative that if there is an algorithm, okay, this is an argument for you to hold with yourself over the weekend. If there is no algorithm, pray tell, how does the market just randomly between buying and selling pressure sell off right at a consequent encroachment level in a wick that I teach you and drop immediately down into a level that I teach you that will be revisited again and then turn on a dime? If there is no algorithm, how is it that there are traders that don't have any information given to them in books and courses and educators? They don't teach this stuff. So how on earth did it just do this very thing and deliver exactly like it did? So think about the delivery from consequent encroachment down here, which I talked about at the time. It's not cherry picked, okay? I told you to watch this at the very second as it was trading there. And where it delivered from here all the way back up into this 60-minute fair value gap. Where's the buy side? Resting right above here. So we went all the way down to this new week opening gap low. We're inside the 60-minute fair value gap again. We've already did the buy side here, so that's not what we're interested in. We want to see, does it want to go above this high and trade in this order block and completely maybe come all the way back up to the high end of that 60-minute fair value gap? Because it's already pierced this low and this low. What was below these lows here? Sell side. How far can it go down below an old low ICT? How far? How do you know how far it's going to go and it won't keep going? New week opening gaps, new day opening gaps, opening range gaps, the gaps between where we closed yesterday and where we open at 9:30. There's 3 specific gaps right there. But that range movement from the consequent encroachment of this wick, after clearing the sell side below this low and this low, we have 2 lows here that are relatively equal. And you always want to put it right on the lower of the low between the 2. So that's, I'm a little bit below it, that's okay. But from here and here. So what's resting below that? Sell side liquidity, sell stops. Traders that would want to protect a long position, they put their sell stop below that. Traders that want to sell short on a breakout, thinking that weakness that comes in, they would see that as what? A reason to be short. So if what I'm teaching you is we attack that liquidity. And the question that comes up a lot is, okay, how do you know how far if you want to be buying these stops? But the question many times comes up is, you know, how can you trust? How do you know? How do you know then when it drops below old lows to be a buyer? How do you know how far it can go? Like, where would you place your stop? Well, in this case, this helps a lot when you have information like the new week opening gap, because we would expect it to drop down. This was in the chart. It wasn't off screen. It was mentioned to you that this is an interesting level. If we drop lower, this is where it's going to likely draw to. It's below these relative equal lows. So below here is sell side. So there's layered sell stops below these lows that you don't know. And the depth of market, the DOM, those orders can be spoofed. Just because you see them prompting you, saying there's this many willingness to be a seller or a buyer at a particular level, doesn't mean that that order is going to be there when price gets there. Spoofing is a real thing. Spoofing is where they put an order there, and then by the time it gets close to it, they pull the order away. So it's a gimmick. Okay, I'm sorry if you like to use that tool and it's helpful to you, that's great. But don't argue and say that that's the reason why the market's moving around, because it's not. But below these lows, there's sell side. So how far can it drop down below old lows? New week opening gap, new day opening gap, opening range gap. There's your 3 tools. How far can you trust the move above an old high for a turtle soup? I just taught it to you. Oops. Magic can come out of nowhere, can't it? So the market drops all the way down through relative equal lows into some random level, new week opening gap, Goes one tick outside of it. Why? Remember what I was teaching you? It likes to create these little mohawks. Okay? These little mohawks that overlap a little bit. Why? Because there has to be what? The bid and ask difference. So if a trader wants that 39.74 and a half, it has to trade where? 39.74 and a quarter. And that's what you got here. Everything makes sense when you understand it that way, instead of taking your price patterns and animal harmonics and Elliott wave things and try to cram all that stuff into a reason why price is going up. It has no reason. There's no basis at all for why the markets are going to be booking this way. It's going to go up for buy stops, or it's going to go up to redeliver to an inefficiency like a fair value gap. That's it. It's either going to go up for that reason for longs to sell their long positions too, or it's going up there to start a new sell-off. So that way shorts can be implemented, and then it's going to be looking for an opposing liquidity. The market goes down for sell stops. It goes below a low or an old lows, or it goes down to an inefficiency that it will reprice to. That's it. If it's not doing that, guess what it's doing? Consolidating. It's totally three conditions. It's going up for one of two reasons, going down for one of two reasons, or it's consolidating. I teach you when it's going to consolidate. When we're ahead of big news or event like this, we don't know what Powell's going to say and how the market makers are going to utilize that. So what is it doing? It's consolidating. We're not trading. Why? Because it's likely to do this. And if it does move, it's uncertain. So you can't really trust it. So there you go. Now you know when the market's going to consolidate. I just taught you. I've taught you before, but I just reminded you this is what it looks like. But when you're bullish, and when I'm bullish, I'm looking for one of two things to happen. It's going to go up to buy stops above a high or relative equal highs. Or it's going up to a premium fair value gap, some kind of inefficiency where the market has dropped in the previous, I don't know, it could be as far as 60 days back. Some old high, some old price decline where there is a fair value gap. It's going to go up into that level there to reprice. That's the only two reasons why price is going to go up for me. That's it. It's simple, isn't it? It's very, very simple. That is not complicated. No matter how much you want to torture it, it's never going to submit to being complicated. That's easy. It's going up for stops or it's going up for a fair value gap. Boom, done. Over. Simple as that. Are you bullish? Okay, you're looking for one of two things. Is there a fair value gap? Nope, there ain't no fair value gap. So what's it going to go for? The stops, baby. It's going to go right up into those buy stops. Just like you're seeing it happen right there. Is it complicated when you look at it that way? Honestly, I'm asking sincerely. Because I don't believe it is. I don't believe it's complicated. It's very simplistic. And it's nothing that you should be wrestling with and trying to feel overwhelmed with. But you're trying to learn it too fast. And you can't rush it. It takes these types of things here, sitting here and watching price action. When we were down here, I said, watch that wick. Okay, that's not cherry picking. That's me taking your attention right to a very specific price level several times. But you aren't going to see these types of setups just because you watch the video. Like, you have to know a lot of things. You have to be in the charts, watching it, paint, key off of specific times of the day. Look for things that have already occurred, which was what I outlined, the sell side below here. These relative equal lows. We went down below it here. Beautiful delivery. That's precise. You can't deny it. Rolls back up in, and then one more time tries to make an attempt to go down here, but there's no reason. Why is there no reason, ICT? How could I trust that? How did you trust to talk about it? Because you could have did it wrong in front of everybody, and they could have been laughing at you. What I've outlined here, the sell side below these relative equal lows. It goes down to a logical level, not some random place, not some random zone. I didn't refer to anything harmonic down here. These levels were already on my chart when it went down there. And then taking your attention to that level right there. This failure swing, you can now anticipate them if you have the backdrop, the foundation behind it, that we've already went below these lows for sell side, and it went to a level that would be expected. Think about what's going on here by doing that. I'm stating that the algorithm will go back down to this level, below these lows, go there and be content with that, and then look to do what? Reprice for an opposing liquidity or inefficiency. We had both buy side and the remaining portion of that 60-minute fair value gap in the shaded area. I don't need it to go all the way up to the top. I just need it to go back to the buy side here. So smart money was buying below these lows. Notice it's doing that when it goes down here. This area here, which is the midpoint of this wick. Let me go back in case you guys just showed up. We were looking for this new week opening gap down here. It delivered it at 39.80 and 3/4. It came down to 39.50, 39.80.50. That's the low. Look up here in the upper left-hand corner. That candle's low is 39.80.50. One tick below consequent encroachment. That is below this low and this low. So the algorithm is remembering what? It's referring back to this low and this low because they're relatively equal. It does not know, listen folks, listen. It does not know your stop. It doesn't know my stop. It doesn't know how many stops. Your broker does. But the algorithm has no idea. It doesn't reference it like that. It just refers to these points, these PD arrays. So the market does what? It reprices back down below those lows, which is a discount, and consequent encroachment. They're all measurable. And there's no need to go back down to that low. Why? Because it's already repriced to the new week opening gap. And done what? The sell side has been purged. This is just returning back to a point of reference for smart money to accumulate longs. If they're going to buy here in their quote unquote smart money, and they are using what I teach as a market efficiency paradigm, that means they're going to buy stops that are below the market in the form of sell side, and they're going to distribute their long positions to buy side that's resting above the market. Willing buyers at a higher price. That's these stops right here. So they're buying sell side liquidity below these lows here and consequent encroachment. They don't fear the algorithm repricing down here because they know it's already done its job. Big, huge step forward in your understanding about price action if you can see that. So if they buy here, and I talked about this live, it's not like I'm going back in time because it's already happened. I said this live here for you so that we can see it. The logic is real, folks. It's real. If they're buying that, what are they holding for? They're not holding for harmonic patterns. They're not looking for Elliott waves and all that other stuff. They're not counting waves. They're not doing any of that stuff. They're simply looking for the inefficiencies above the marketplace. Where is it in here? Nowhere. Here. We've already done that several times. Buying here, they're going to go exactly where I said it was going to go. The remaining portion of that 60-minute fair value gap up here that hasn't been traded to, once it went lower here, we've only delivered one time here. We went up to a quarter of it here, which is, again, not random. Then it went to halfway, consequent encroachment, and then ran through it. Like I said, that's where the buy side is. So smart money buys discount, sells to a premium. Buy stops at resting above here. They knew those buyers wanted to buy the market when it was down here. When they're down here, smart money, the paradigm shift that you're being taught to have in looking at price action, because it's algorithmic, is you're buying it here with the same mindset that they have. Smart money sees this as buying sell stops at the most opportune time. It's the precise time, folks. It's precise. You can't make it any better than this. The logic is right there. And buying that with the expectation of seeing it go where? Right to those buyers that want to buy high. Now, they don't want to buy high to buy a long position. They have they have a short, and they're holding on to their position here. Maybe there wasn't a lot of shorts. It doesn't make a difference because the algorithm doesn't know the level of float that resides above that. It means the number of orders. How many buy stops are resting above that high? I don't know. You won't ever know. The algorithm itself does not know. Buying it cheap, selling it to people that want to buy it higher. Why? Because I'm targeting their inability to know how to trade. I'm targeting their shield, their defense. I'm busting it in like the SWAT. I'm literally going through it. I'm teaching you how to do that. I'm sorry if it doesn't meet the nice feel that you think investing is supposed to be about. It's not like that, folks. This is war. And when you look at the charts, I have absolutely no moral conflict at all about taking your money or anybody else's money when you're on the wrong side of the marketplace, because you all sign the same risk disclosures when you open up your account. Everybody knows that you're likely to lose money. So if I'm buying down here, I'm doing what smart money's doing. I'm told you that that's what's going to happen there. From here, watch that. And we want to see it deliver up to this area again, but more specifically, the upper half. Why? Because it only went to here, leaving from this high up to the high shaded area here. That's not been repriced to. We only passed through one time here, then up to a quarter. So think about it like this. The range on that hourly fair value gap has been repriced to here, right there at that moment. Then this high here takes it up to that level. So the remaining portion of that fair value gap, in my mind, I'm seeing that range left. I'm ignoring all this. So you're looking at all these things trying to guess which one I should have been looking at. I'm teaching you how to internalize it, because this is the part that the algorithm sees now. It doesn't need to look at all these other highs. This is the one that matters now, because it's traded up inside that old 60-minute fair value gap, but it's left in this portion of it where it has not redelivered to it. It's only been offered sell side. So the efficiency model is that price needs to trade up into that area and deliver price that way. It does two things. It does that redelivery and goes right for the buy stops I told you it was going to aim for. Now, isn't it convenient? Isn't it convenient that the market just so happens to run right up there, clear those buy stops, and now we're right back in the middle of the range again? Hello? Hello? Are you paying attention? Are you paying attention? Are you playing with your Game Boy? Are you texting your girlfriend? I'm listening to this guy go off on YouTube. No. You need to be paying attention, taking notes. Folks, this stuff repeats every friggin' day. Every day. I talk about it in Twitter. I tell you exactly what candle to look at. I tell you exactly what it's going to be aiming for. I've been doing it for months. My private students have watched me call this on a daily chart just the same way. And it can be done on a 1-minute chart, 5-minute chart, second chart. Yes, that's less than a minute. You cannot, absolutely cannot find anything fucking better than this. I'm sorry. This is perfect. This is the market. The market's going to go where the money is. If there ain't the money in there, they're going to engineer it. That's the way it works. Above that high right here, buy stops. Somebody's short. We don't know. Retail Rick, he's short here. He's going to put a protective stop loss in there because the books say put your stop loss right above the high. He feels great when it goes down. He's going through all this chop. He's thinking, okay, maybe it's just one of those moments where I have to wait. ICT talks about this right here as a fair value gap. I got to trust it. He don't know what he's doing because he watched 3 videos and now all of a sudden he's a professional, right? The market drops down. He's thinking, all right, I'm all in now. I'm adding to it. It's great. Go watch TV. Go play golf. I'm going to be good for the rest of the day. My stop's in place. What do you make? A mistake. He traded with logic that doesn't work. He doesn't know about the new week opening gap. He doesn't understand liquidity. He doesn't understand the facts that this day is going to be consolidation because of the Fed. The market's already delivered this week, folks. It went to that dollar objective.